Je m'appelle Marc Le Gardeur. Je vous le précise parce que j'ai un homonyme chez Xebia. Donc moi, c'est Marc. Je suis coach agile à l'échelle. Au quotidien, j'accompagne des organisations plutôt de grande taille dans leur transformation agile. Qui dit organisation complexe dit souvent silotage, ingénierie complexe. Et comme le disait Edward Deming, c'est le rôle du management de raisonner au système dans son ensemble. Il ne suffit pas dans une organisation que chaque entité, que chaque silo s'optimise, mais il faut penser à optimiser le système dans son ensemble. Alors pour vous parler de ce sujet, on a invité un expert du domaine. Il a commencé sa carrière dans les années 80, il était consultant chez McKinsey. Il a aidé pas mal d'organisations à se transformer, à changer leur manière de concevoir les produits. Il est conférencier, il est auteur de 3 best-sellers, dont Principles of Product Development Flow. J'en suis à ma 3e lecture, je n'ai pas encore tout compris, mais c'est un livre très riche. Donc je vous demande d'accueillir Donald Reinertsen.
Merci. Bonjour, monsieur, mesdames. I'm not going to do this in French because I will be smarter in English than I would be in French. So what I want to talk about is system thinking. What I will give you is sort of an engineer's perspective on system thinking, and I think I'll distinguish from some of the more theoretical approaches to system thinking to how I, as an engineer, use it to help improve things in product development. And so the subjects I want to talk about, I want to talk a little bit about the definition of system thinking and systems. Then I want to go into some aspects of system thinking that I think are quite useful for the development of products. And I'm going to talk a little bit about the use of an economic model to understand how I can optimize a system. I will talk about how you make trade-offs, compromise between one variable and another. I'm going to talk about the idea of uncertainty and how we manage uncertainty. And I believe there are some very dangerous ideas from the manufacturing domain that get into the domain of product development, which are poorly, or which do not represent the best thinking on how you deal with uncertainty. And so I'll explain what I mean then. And then I'm going to talk a little bit about how we can exploit uncertainty with the primary tool we have, which is feedback loops. So I want to talk a little bit about the nature of the feedback loops we use to get uncertainty to behave in a different way. And you'll understand when I go into it what these sort of abstract terms mean. Okay, so first, let's start with what is a system. This is sort of a classic definition of a system. This is from INCOSE, which is the International Council on System Engineering. It's a pretty standard definition. It's a system is a collection of different elements that produces results that are not obtainable from the elements alone. And from that comes the basic idea that the value in a system is created by the interconnections in the system. The primary value, there is some value in the elements, but it's the interconnections that really create value. And any engineer that has worked with systems realizes the value is created by the interconnections, but in fact, all the dominant failure modes of the system are also created by the interconnections. If you didn't have interconnections, you would have orders of magnitude fewer failure modes in a system. So they both create value and they create failure modes. System thinking is really what I say on this first point, is how we define system thinking is, just in a general sense, is to be able to see all of the consequences of our actions on a larger physical and a larger temporal scale, a larger time scale. So you understand what you're doing to the system over a very long time frame. Now that's a bit like asking somebody to be God, because there is no outer boundary on, for system thinking. It goes to infinity, thinking all the way to an infinite time frame and an infinite physical space. For an engineer, you do not want to think that way. You want to think in a more restricted way, and I'll talk a little bit more about that. Now, the other distinction I would make is that many of the systems that are described by system thinkers are things like ecological systems, where the primary objective of the system is to maintain the status quo. And there are lots of systems, the economic systems and, the distribution system that brings water into a city and things like that. But most of the focus there on those systems is how do I make it continue to operate? And I believe there's another type of system where we try to intentionally create change, and I just label this as an intentional system where I have a specific objective. Because, while Deming will tell you to, do system thinking and optimize the system, if you ask him, how do I quantify the performance of the system and how do I know it's optimized, you wouldn't get a very good answer there. Because, and for the systems that we attack in engineering, we really need to think about what is the objective we're trying to optimize for. So the standard definitions of systems is that they have inventory, they have flows, and they have feedback loops. As an engineer, I would also tend to add that the boxes that we have in a system actually have operations that change the value of the things they are operating on. So the classic definition I don't find particularly useful as an engineer. There is a really important aspect to the systems that we have in engineering, which is that in product development, our inventory is invisible, our flows are invisible, our feedback loops are invisible, because in a physical manufacturing system, our inventory is physical objects, and we can see our inventory, we can see our flow, we can see our batch ties, we can see the feedback flows in a process. In engineering, our inventory is information. Information is intrinsically invisible, and the other interesting thing about information is a physical object can be in only one place at a time. Information can be in more than one place at a time. So many of the models people use for systems thinking are models based around the physical flow of objects sequentially moving from one place to another. They are not as based on network-type models where information can propagate to many places at the same time. Now, in an intentional system, a system where you're trying to accomplish something, you ought to have an overall goal, and if you know the goal, that is what you use to measure whether you're achieving optimization or not. Now, in the world I work with, which is primarily for-profit companies, the question of what is the goal is pretty straightforward. The goal of most of the companies I work with is an economic goal. And so one of the things we want to do in using system thinking in product development is to think in terms of economic terms. Now, our systems are going to have multiple interacting parts. Many things will be changing and they will affect one another. Our objective is to deliver economic results to the shareholders. If we're going to be able to deliver economic results, we need to understand how our choices affect the economic outcomes. And we wouldn't just like the PDG to understand that. We'd like everybody on the team to understand that aspect. And so I'm going to talk about a little practical approach to how this works at things. And when we can get everybody on a team to understand the economic effects on their choices, then they can all align their behavior to achieving the economic objective of the project. And I'll tell you a little story about a team at Boeing and how that worked. So let's start with a typical question that we might have in a product development process. I could look at a queue. I used to teach classes at Caltech in California, executive courses. And about 95% of the people who came to the class had a queue in testing, in product development, a queue on what we call the critical path that ends up delaying product development. Now, I could look at 12 months of history for a test department, and I could say, over the last 12 months, you were operating at 90% utilization, and you had an average of a 4-week queue. And then I could take that same data and say, if you had operated at 80% utilization, you would have had a 2-week queue. And then, because these are stochastic queues, they rise and fall over time because of the uncertainty. Now, the question I would ask them is, are you better off with a 2-week queue and 80% utilization, or are you better off with a 4-week queue and 90% utilization? And in fact, that is an impossible question to answer, because I'm asking you to compare 10 percentage points of utilization with 2 weeks of cycle time. And those two variables are in different units of measure. The only way you can make a comparison, and this is the fundamental problem, is that when you have a system with more than one moving part, you've got to get things into the same unit of measure. If you just had one unit of part, it would be very simple. You could tell people eliminate waste or lower unit cost and things like that. Really simple problems when you only have one moving part. You have to do quantification when you have multiple moving parts. And the question is, what are you going to quantify it as? What are you going to choose as your unit of measure? And my experience in the last 30 years is when I'm trying to influence management, I usually use life cycle profits. How much profit will be delivered to the shareholder during the life of this product? That's usually what we define as the objective of the program, to deliver profits to shareholders. And then we ask the question and we say, well, what will happen if we change the... I call these variables proxy variables because we use them as a substitute for what our real objective is. And they are not a bad substitute when there's only one moving part, because we know if the revenue goes up, le chiffre d'affaires, that will raise the profits. And we know if the unit cost goes down, that will raise the profit. The problem occurs when at the same time cycle time is going up and efficiency is going up. Because we know high cycle time is bad for us, we know high efficiency is good for us. We've got to quantify those to be able to sort it out. So how do we do that? We basically just assume the project is a black box. We treat these as the inputs to the black box. and we change one at a time, and we see how they affect life cycle profit. And it's known as a sensitivity analysis. We've done it for 100 years in finance. It's nothing particularly new. As an engineer, I might explain it to you is when I calculate cost of delay, what I'm really doing is I'm calculating the partial derivative of life cycle profit with respect to the introduction date of the product. But that's what we're doing. We're changing one thing at a time. We're seeing how much it changes profitability. The term MOP here stands for measure of performance. But I calculate sensitivity factors, and then that tells me, this slide didn't transfer that well, but that tells me how much a different change in each one of the variables will end up impacting my life cycle profit. So this is saying that a 1% change in the unit cost will cost me $150,000. And this bar is saying that a 1 month delay will cost me $500,000. So now if somebody comes to me and says, give me an extra 2 months of time so I can lower the product cost by 2%, you can say, well, I know it's good to lower the cost by 2%. I know it's bad to increase the cycle time. What is 2 months of cycle time worth? It's worth $1 million, 500,000 times 2. What is 2% of product cost worth? It's worth 150,000 times 2, which would be $300,000. I do not want to trade $1 million of cycle time for $500,000 of product cost. I am willing to trade $1 million of cycle time for $3 million of product cost. So the idea is we don't fall in love with individual objectives like doing it fast or being efficient and things like that. We sort of fall in love with optimizing the overall system, the overall impact of all of these moving pieces varying. Now, when people first encounter this sort of modeling, they say, wow, you probably cannot do this very accurately. Can you calculate cost of delay accurate to 3 significant digits? And the answer is, no, we can't, but we really don't have to. We have to be better than intuition. And the average intuition, these slides apparently didn't convert that well. The average intuition is 50 to 1. So what I'll do is I'll go into a company, I will end up I'll get 10 people in the room who are all able to delay the product, and I ask them, what do you think it will cost the shareholders in life cycle pre-tax profit if we delay the launch by 30 days? I tell them, write it on a piece of paper. We'll rate them from the highest to the lowest number we get. The average range is 50 to 1. Somebody will say, and you can ask the people in your organization, what is a fair price to pay to remove a month of cycle time from this project? And you will find the answers differ all over the place. Unless you're doing some analysis, you will have radically different answers for that question. Okay? Now, what's the best I've ever seen with intuition? It's this bar, which is a 10 to 1 range. Usually, when I do an analysis and I split the group into, I can take a group and split them in 2 and put them in 2 different rooms, and I have them analyze the same product, I will get about a 2 to 1 range. I never have gotten a 50 to 1 range when people use analysis. The only time I get 50 to 1 ranges is when people use their intuition. And for those of you that are worried, I'm not really talking about eliminating the role of intuition. What I do is I use intuition for the input variables. I use the judgment of people for the input variables of the model. I don't use their judgment to guess what the answer is. I use addition and multiplication, which work actually much better than intuition does. Now, let me give you the Boeing example. So Boeing was partway through the development program for the Boeing 777. The Boeing 777 was overweight. They had a performance guarantee to United Airlines that they would pay the excess fuel consumption for every plane United bought for the entire flying life of the plane if they breached the performance guarantee, if they didn't achieve the target weight. So it was going to cost them hundreds of millions of dollars, and they said, oh, we need to do something. They finally, discussing with the engineers, they finally came up with a system. They said, any engineer can remove weight for $300 a pound. If you can do a material change, a design change, a material substitution that removes a pound of weight per plane, and it costs less than $300 per plane, you don't need anybody's permission to do it. Now, the supervisor could go to a higher level, the program manager could go to a higher level for special cases. But the interesting thing about this is this $300 a pound was a system-level optimum decision rule. And so they had 5,000 engineers on that plane making system-level optimum decisions without having to talk to anyone else further up in management. And I'll give you a sense of how different this is from what would be traditionally done. When I was a consultant at McKinsey, what would have happened is if you came to McKinsey with this problem, McKinsey would have said, this is a key performance indicator. It is worth hundreds of millions of dollars. If you miss the weight of the plane, it is an economic disaster. We need to have the most important person worrying about the most important performance indicators. Therefore, the program manager should participate in the weight decisions. That would have resulted in a 50-year development program if you had the program manager involved in all the weight decisions. So instead, what they've done is they've done something very intelligent. They said, I can split a decision into two different dimensions. One is the logic of the decision. The other is who applies that logic. They said the program manager needs to control the logic of the decision. Once we have controlled the logic of the decision, then we can have anybody in the organization do it. We don't have to have management involved if we know what price they're going to pay to make the decision. And so this is really critical in releasing control to low levels of the organization to enable people to understand, because people don't make bad economic choices because they're trying to undermine the organization or to cause the program to fail. They make bad economic choices because they have no information about the consequences of the choices they're making. So that's my first point, is we need to understand the economics. Now, as you understand the economics on these different factors, then you start discovering you have very frequent trade-offs that you have to make between, very commonly, one big variable you must be compromised against another big variable. And these trade-offs produce what we call U-curves because they're shaped like the letter U. And there are some interesting mathematical aspects of these U-curves that I'll talk about. I'm going to give you two basic examples. One is capacity utilization, and the other one is batch size. I'll show you the U-curves that show up for them. Capacity utilization, I always explain the issue of queuing and capacity utilization by using the périphérique. I say, anybody who has been in rush hour traffic knows how a queuing system behaves. Because when the system is busy, I think that's l'heure de pointe, then if I remove one lane of capacity, which is 25% of the capacity of the road, the cycle time will double or triple. If the system at 3 o'clock in the morning is lightly loaded, I remove one lane of capacity and I see no change in cycle time. So your intuition about a queuing system is changes in loading produce a non-linear impact, and the non-linearity depends on the level of capacity utilization. And if you studied real queuing theory, you would see your intuition is exactly right. This red line is the queuing curve for a typical queuing curve, where the closer you get to full utilization, the bigger the queue becomes. Now, the important thing about that is that excess capacity is what allows us not to have queues. So in a manufacturing plant, we will never load a manufacturing plant over 85 to 90% utilization because the queuing problem becomes too severe. Engineering, which has more variability, the people going into my Caltech class were loaded on an average to 98% utilization, and they had obviously they had queues in their process, but again, because the queues were invisible, they were not managing the queues, and that was the problem. Now, some of these lines almost show up. The green line, I'll sort of trace that with my beam, goes like this down to 0. That's the effect of excess capacity. The red line is the size of the queue, and so the cost of the queue. As the queue gets bigger, we incur more and more cost. And so what happens is, as we remove more and more capacity in the system, we reach a point where the queue is growing faster than the savings we're getting, and then the total cost starts going up. So there's a very hard to see blue line here that is the U curve for capacity utilization. And the interesting thing about these U curves is they have very flat bottoms, so you don't need to get the right answer. You can choose 60% or 50% or 40%. You can be 10% either way on utilization, and it makes very little difference in the economics. And this is important because you don't need highly precise numbers to deal with U-curve trade-offs in a system. The second important point is that with the U-curves, you want to always stay, the problem is not finding the right answer, it's staying away from the wrong answer. The closer you get to 100% utilization, the bigger your problems become. Now, here's another example of a U-curve. This is on batch size. This is just a diagram showing how some people would review drawings in their engineering process. Some people would work for 10 weeks and then they would review a large batch of 200 drawings. Other people would work each week, they would review 20 drawings. And the question is, what is the right number of drawings to review? What is the batch size? I think French is la taille de l'eau is the proper term for it. But what is the right taille de l'eau? And this is, the answer is that there's an economic batch size equation, and this was originally proposed in 1913, 105 years ago. And the man who wrote about it said most engineers do not understand the economics of batch size. And my son just graduated from engineering school a couple of years ago, and I guarantee you that most engineers still do not understand the economics of batch size. Now, there's always a trade-off between holding cost and the cost of the queue, the transaction cost and the holding cost. And I'll give you a simple example, is that let's say my family ate eggs for breakfast every day, and I said we were going to the supermarket too often. And I said, from now on, we need to buy 1 year worth of eggs when we go to the supermarket. So what would happen would my transaction cost would be very low because I wouldn't go to the supermarket except one time a year. But I would have to buy 2 or 3 refrigerators to hold the eggs, and I'd have money tied up, and I'd have perishability costs. Those are the holding costs. And then, let's say my kids said, this doesn't make sense. We Googled it. We read about lean manufacturing. In lean manufacturing, they say the right answer is one-piece flow. I said, oh, okay, we'll try that. Google's never wrong. So I say, from now on, we're going to have one-piece flow. We eat an egg, we buy an egg, we eat an egg, we buy an egg. The holding costs are very low, but the transaction costs become very high. And in fact, silly slogans like one-piece flow never solve these problems. When you're dealing with economic, you can't use slogans as a substitute for quantification because the slogans usually drive you to one extreme or the other. And operating at the extremes is never the right place to operate when you have trade-offs. So high precision not necessary, stay away from the extremes. Uncertainty. Manufacturing has a very strong aversion to uncertainty and variability. A lot of people in software have inherited that because they think manufacturing is more predictable and we can be predictable as well. That's really, minimizing variability is not really as sensible an economic objective in product development. And I want to show you this. I'm going to show it to you in a little bit of a technical way, but it points towards a different approach. There's a nice writer named Nassim Taleb who writes about uncertainty, and he's written a bunch of books on financial markets. One of the terms he coined was anti-fragile. To describe systems that get better outcomes in the presence of variability. So I just want to show you this. I'm going to show you it using some financial terminology and things, but this is the, I believe, the Ancienne Bourse de Paris, right? So I can talk about finance in this building, I think. Okay. So this is the option pricing model. What happened is, in the 1990s, Robert Merton and Myron Scholes won the Nobel Prize in Economics for the Black-Scholes option pricing model. And I want to show you a little bit about how that model works and things. The first graph, the graph on the upper left, is a probability function. And this graph is what we call a payoff function with that little orange line. So when we try to calculate, an option gives you a right to buy a stock at a certain time in the future at a fixed price. And that is called the strike price. And right here on the chart is where the strike price is. If the price at expiration is below the strike price, you throw the option away, because you can buy the stock on the market cheaper than you can if you use the option. If the price is above the strike price, then for every dollar it's above, you put another dollar in your pocket. Now, when you ask the question, am I going to actually get that money, it depends on how likely it is that the price is at each one of these levels. Now, this function here, this probability function, is telling me what the expected price is. So what we do here to calculate the expected value of an option, we do what is called a mathematical expectation. It's a probability function times some other function. In this case, it's a payoff function. So I say, if it's this probability, it will be at this price level. And if I make this amount of money, that produces my third graph that is showing me how much money I'm getting from each of the price levels. The area on the right side of the graph, which is above the 0 line, is larger than the left side. That is why options have value. Now, the interesting question is the value coming from the probability function or the payoff function? The probability function is basically symmetric. All of the value is coming from the payoff function. Now, if a lean manufacturing person went to an economist and said, what we have learned in manufacturing is minimizing variability maximizes economic payoffs, the economist would laugh in their face because they would say, yes, there are situations where that is true, but that is not a universal truth. In fact, with option theory, what happens if I increase the variability of the stock price? The two tails spread out on both sides. If it spreads out on the left side, it always does the same amount of damage. If it spreads onto the right side, it generates more payoff. So on this slide, what I've done is I've done two different levels of variability and shown the areas, and you increase the area. So in something like a stock option, the more variable the stock price becomes, then the more money you end up making. Variability, we call it volatility in finance, but that increases the payoff. So I think the important thing about this is it's really saying, if you want to create value out of variability, you have to create asymmetric payoff functions. Now, some of you have probably heard of Eric Ries's lean startup ideas about doing an MVP, and then if it works, you keep going, and if it doesn't, you pivot. That is very much aligned. He doesn't explain it this way, but that's very aligned with that sort of thinking. Because what he's really saying is, when I try something new, I have a negative tail on the distribution and I have a positive tail. I want to prevent the negative tail from doing damage by shutting down the program if I get a bad outcome. I want to capitalize on the positive tail by investing more if it turns out to work. And so in reality, what we're trying to do, the way we use variability, I think, in a modern way in product development processes, is we're starting to focus on how do I amplify the good outcomes and how do I shut down the bad outcomes quickly. That will enable us in the presence of variability. And I'm not saying celebrate variability. It is when variability runs into an asymmetric payoff, and I'll next talk about how we create those asymmetric payoffs, okay? Because the way we create them is with feedback loops. If we buy information in small batches and we make decisions based on that information, we can increase the payoff. So let me give a simple, toy problem to just illustrate that. Let's say I offered you a lottery ticket worth $3,000, and you had to pick a 3-digit number, and if you pick the correct 3-digit number, I give you $3,000, but I charge you $3 to play. That's this first method. That is obviously a break-even game. One chance out of 1,000 of making $3,000 is worth $3, I think. But what if I changed the game slightly and I said, I'll still charge you $3 to buy 3 digits, but I will charge you $1 for the first digit. I will give you feedback whether you have picked the correct first digit, and then I will let you decide whether you want to buy the second digit, and then I'll give you feedback, and then I'll let you decide whether to buy the third digit. That second game looks very different. There's a 100% chance you're going to buy the first digit, 10% chance you will buy the second, 1% chance you'll buy the third one. And the second game has an average payout of $1.89 instead of being a break-even game. Now, somebody trained in finance would say, because the payoff is still the same in both games. It's still $3,000 if you pick the right number. It's still one chance out of 1,000 that you're going to pick the right number, and it's still $3 to pick 3 digits. Somebody trained in finance would say that the second game, the economics of the second game has changed because we have created embedded options in that game. In French, I think it's option intégrée. Because the shutdown options are what is altering the economics. So in fact, when we're trying to create these asymmetries in product development processes, we're trying to buy information in small batches so we can get it quickly, so we can make a decision to either shut down or amplify a particular activity that we're doing. Okay? So that's really the answer. And what Nassim Taleb refers to as anti-fragility, he said, the problem, most people think robust is the opposite of fragile. So a fragile system is hurt by variability, a robust system is not. Taleb says, no, we should be thinking of an anti-fragile system which in the presence of variability, it gets its best outcomes. Things that get better outcomes, the higher variability is. That is the definition of anti-fragility. But unfortunately, Taleb doesn't tell you how to create anti-fragility. He just talks about, it's sort of like anti-gravity. It's a great concept, but he doesn't give you too many answers. All right. So that's what I wanted to talk about in sort of, I've almost used up all my time. Oh, okay. I just want to make some final tips based on what I've said, and then a couple things that I haven't said yet. In my experience, it is much easier to talk about system thinking than it is to do it, even for the experts. So you'll see Deming talking about it's always better to prevent problems than it is to correct it. That is actually locally optimizing correction cost as a local, you know, he is communicating, I understand nothing about system thinking when he locally optimizes correction cost instead of optimizing the sum of prevention and correction cost. For example, all of you will use a spell checker on your word processor, and if somebody told you it would be better for you to prevent spelling errors by becoming a perfect speller and a perfect typist, you would say, the cost of becoming a perfect speller exceeds the cost of correcting every document I will do for the rest of my life, particularly in French, because French spelling can get mischievous at the end of words. So you make very sensible choices to trade off correction cost against prevention in your real life. You should not believe silly things like prevention is always better when somebody tells you that because they say that's system thinking. When you pay attention to systems, a lot of people stop, point number 2, a lot of people stop with the topology. They think they understand a system if they know how things are connected together. In fact, it is much more important to understand the degree of coupling between system elements and the amount of margin that you have between system elements and things. Because not all of the connections in a system really are important. You know, you'll read literature on systems saying, if a butterfly flaps their wings in the Amazon, it will create a tornado in Paris and things like that. You know, no engineer would sell a proposition like that. It would be a mathematician or a physicist that would propose. There are so many intervening variables and such weak coupling between that event and the outcome, you would never rely on that as a system performance indicator. The system doesn't have to be completely predictable to be manageable. We are also going off on the other direction of saying, because I can't predict anything in a system, that means it's complex, and if it's complex, you can't manage it. In engineering, we have been managing complex systems for 100 years. When we think about fluid flow, for example, we can't predict what every molecule is going to do, but we look at the bulk properties of fluid flow, and we can predict when turbulence will occur in a system, even though we can't predict what every molecule is doing. So in many, many of our engineering systems, do you think messages on the internet are routed based on knowing what the condition is of every router on the internet as a system-level optimization? Not even close. They look at the routers that are nearby, and that gives a good enough answer when the system is constantly changing. So don't let complexity act as an excuse for not analyzing technical systems. I've told you that the extremes are bad. I say beware of the slogans. This one, improving parts never improves the system. That is a statement of one of the great system thinkers, Igor Antsov, who is a lot of these system thinkers are much smarter than I am, but being much smarter than I am doesn't prevent them from saying stupid things. And you know, in fact, as an engineer, every time I've ever had to fix a system, I always fixed it by changing one of the elements. So in my experience, if you know the system-level consequences of changing an element, that is precisely how you change the performance of a system. And then finally, I'd say just beware of centralized control, because you need to take a little more sophisticated approach to the idea of the control is either going to be central or decentralized. The Boeing example was a very good one because what you saw was that the logic, the decision rule was centralized at the level of the program manager. The actual carrying out the individual decisions was down at the lowest level of the organization. So was that centralized or decentralized control? I would term that aligned decentralization, where I had mechanisms to maintain the alignment of autonomous actors. Okay? And that's all I really wanted to cover. As Mark mentioned, this is a challenging book. You don't. One person said, I read it on a plane in 2 hours and I got nothing out of it. And if you read it in 2 hours, you will get nothing out of it. It's made to be read a little more slowly. So I think I can take a couple of questions, maybe, not too many.
Yes, on peut peut-être prendre 10 minutes pour des questions-réponses. Je vois pas. Question?
Oh, I forgot to tell my French joke. Can I tell my French
yes.
joke? Okay.
Give us your French joke, please.
This is a French joke, not in the sense, it makes fun of engineers, but its setting is in France because it's at the guillotine. So it's a joke that's been around in America for a long time. So a lawyer and a priest and an engineer are brought to the guillotine, and they are sentenced to death. And so first they bring up the lawyer and they put him on the guillotine and they pull the rope and le couperet se tombe, but it stops about a foot above his neck. So they say, okay, this is an act of God, you're set free. And then they bring the priest, and the priest is brought up, and the priest says, they ask, do you have any last words? And the priest says, what you're doing is against the laws of God. And they say, merci beaucoup. And then they pull tirer la corde. But it stops about a meter above his neck. So then they bring up the engineer, and they ask the engineer, do you have any last words? And the engineer looks up and he says, I see what your problem is. The rope keeps slipping off la poulie, but real engineers love problem solving. Sometimes they don't pay attention to the context, the system around the problem that they're solving, but they love to solve problems, whether they're French or American. So, okay.
Thank you very much. Okay, thank you, Don. It's over. I have a question there.
If I'm not mistaken, you mentioned the scientist who got the Nobel Prize for the option model.
Yeah.
And didn't they bankrupt in the LTCM a few years after that?
Yes, in fact, Robert, I think it was either Robert Merton or Myron Scholes, or both of them, that together were the technical advisors for long-term capital management and things, and they were convinced they had eliminated the risk in highly leveraged financial investments. And I would say they made a very fundamental statistical mistake, which is during normal times in financial markets, lots of assets are uncorrelated. And when you blend together uncorrelated assets, you reduce the variability in the portfolio. The problem is during a financial crisis, assets are correlated. They all go down, sort of like what's happening today. They all go down at the same time. And so your theory that you're eliminating risk by having a large portfolio is completely false if you're using the math of calm times to predict the math of uncalm. And so, yeah, even really smart guys make mistakes. One of my professors at Harvard Business School was also on long-term capital management. He was a very smart guy, but they needed the US government to bail them out on that. But, yep, it was sort of bad assumptions. No, well, I think what they really made, they didn't do bad computations. They just made some fundamentally bad assumptions about the inputs, about, nothing broke in their computation. They just said, look, if it was all portfolio theory. You put a bunch of stuff together, you preserve the average return, you reduce the variability. And that is only true when things are uncorrelated. And I mean, I'd say it's much more a case of a bad assumption, and that bad assumption has not gone away in financial markets even today. So I think you're going to see, depending on what's happening now, you'll see a lot of damage being done because they still believe those things. Okay.
Okay, thanks again, Don.
Okay, merci beaucoup.